in J.C. Parets. He's a Marketfy Maven, founder of Eagle Bay Capital, joins us every Thursday to give us his colorful outlook on the market. Money
Hey,
man.
this is JC.
J.C., Joel, and Dennis here. How you doing?
I'm doing well, guys. Good morning.
All right, so here we are in the heart of earnings season, hanging up near all-time highs. Before we go into individual issues here, what do you think? We're just resting here, getting ready to blast off another to new all-time highs, despite not so impressive numbers from Wall Street.
I don't know whether the numbers are impressive or not. They like to make a big deal out of the earnings season. Quite frankly, I think a lot of that stuff is already priced in before earnings season. I got to tell you, I really like this consolidation in S&Ps that we've been seeing. As we keep bumping into this 2,100 and change level. I'm in the camp that the more times that the level is tested, the higher the likelihood it breaks. I find it hard to believe that we're not going to break out. I think we see all-time highs pretty soon.
Is it concerning to you at all, though? Like, I know you're not a big numbers guy, but we've seen a lot of revenue misses here. And also, I know you're a technical guy, and you're saying you think we break out, but really over the last 3 or 4 months here on the S&P futures, just looking at them here, we've had formidable resistance up here just over 2,100. What makes you think that this is the time that we might break out now?
Again, I'm in the camp that, revenues, all these revenue misses and, whatever the case may be. I'm not in the camp that has anything to do with the overall market. And like I said, I think a lot of that's already priced in. You're hearing a lot of blame on the rising dollar. It's not a secret the dollar's been ripping over the last year. So, to think that the market isn't smart enough to already price all of that in, I think is irresponsible. The market is a very, very smart discounting mechanism that, if we're here talking about, weaker revenues and, the stronger dollar affecting these companies, I mean, come on, guys, to think that the market isn't already pricing that in, like I said, I think that's irresponsible. So, what's the reason that I think that we break out to all-time highs? First of all, we're seeing a lot of healthy sector rotation. One of the strongest sectors, over the last few months has been energy. You're seeing strength out of the materials. So you're seeing that rotation. Financials are starting to, poke their heads, as money comes out of, the healthcares of the world and the discretionaries and the semiconductors that, were prior leaders. So, from a sector rotation standpoint, it's hard not to like the action. I've been telling you guys, pounding the table about the whole mean reversion, the whole emerging markets, metals, energy space, mean reverting, and we're seeing that. And I think it's very difficult for the market to have a severe correction if companies like this with massive market caps, particularly in the energy space, as they're rallying, these are huge market cap companies, guys. So, they're big components of the S&Ps. So, yeah, we've gone nowhere, but underneath the surface, that rotation is healthy.
What about a stock like Caterpillar here today? You gotta like that, because here's a stock that was weak. And what I've noticed here is a trend where the leaders maybe aren't so much the leaders anymore, but some of the laggards in the market are actually starting to find bids. So we are seeing a little bit of rotation from the leaders to the laggards. And Caterpillar's been a laggard here for a long time. This morning, obviously, good earnings report, but it was popping even before that. It's caught a bit really a month ago. What do you think about this rotation from the leaders to the laggards?
That's exactly what I was just saying. In fact, Caterpillar, I've been telling you guys the last few weeks, I love Caterpillar. It's been my favorite name because I think it incorporates all of those themes that I just mentioned. The whole, emerging markets, base metal, energy complex. I mean, that's, Caterpillar
Right.
at its finest right there. So, yeah, Caterpillar's actually been my favorite name. I love it. I'm not surprised it's up, 4 points right now. I mean, again, you talk about, the stock market being a very intelligent discounting mechanism. You just hit the nail right on the head. Caterpillar's already been rallying prior to this quote-unquote earnings release or whatever that they came out with this morning. It's nothing new.
And JC, I know you're not bullish everything here, and I kind of wish I would have read your article on IBM before I took some shot at some weekly calls in it. I was looking from a technical perspective here, but you had the technical breakout on the day of earnings. You got a pop over 170, not quite to that level that you were looking at, 172 and change. And now we've kind of pulled back here, and it's like it's still kind of threatening with a technical breakout here. What's your take on IBM?
I think it's a disaster. I don't think there's anything to like here. Yeah, I mean, there's a little bit of a mean reversion taking place, but price is trending below a downward sloping 200-day moving average after that horrible gap down in mid-October, there's really nothing to like here from a structural perspective. And I think any rallies, I think you fade that 170. Anything into that level, you sell that very aggressively. So any rallies that we're seeing here is counter trend by nature. You're fighting a lot of downside pressure. So again, yeah, sure, for a mean reversion, maybe, but other than that, I mean, this thing's a mess. I mean, there's so much better places to be. I mean, think about it. When you go across the market and you're looking at all these stocks, I mean, is IBM really the one that you're going to pick to be in?
I mean, okay, JC. So now I'm confused a little bit here. So I just want to get your thoughts because you like some of the other laggards, and IBM is definitely fits that bill of laggard here. Some of these other stocks you were talking about are definitely below their 200-day moving averages still. But you've made some great calls on some of the money rotating, especially the energy stocks. What is your reason for not liking a stock like IBM but liking some of the other laggards?
Right, that's a great question, actually. First of all, the other laggards are part of an overall underlying theme that are benefiting from a weaker dollar. Like I said, the base metals, the energy complex, things like that. IBM is a different, totally different animal. You can't put that in that category. Because it's just a completely different name. And not to mention that a lot of those names that we mentioned, the Caterpillars of the world and, the energy names, they were substantially below their 200 days. IBM is right below it. So from a risk-reward standpoint, that mean reversion process in IBM has already been taking place for a while. I mean, we're up from 150 up to 165. So this whole mean reversion has already been taking place, but I don't categorize it with the others. I hope that answers the question.
Yeah, that does answer it well. And I guess one other consideration, too, is that some of the tech stocks, if you consider IBM still a tech stock, have performed very well, and it has not performed well on that tape. Now that you see some money coming out of some of the, the tech stocks here, you wonder, what that does bode for IBM. So, great point there, JC. What else is on your radar? Talk to me. If you think we're making new highs, you talked about the energy, talked about some of the metals. What else is on your radar here?
Social media.
I like shorting Treasury bonds still.
Yeah?
Which is unbelievable. I mean, you guys know me. I've been the biggest bond bull ever over the last 18 months or so. Pounding the table bullish bonds. The rates are staying lower, and overall, from a structural perspective, I still think rates stay down. But short-term tactically, the last month, I've said you got to short bonds. We're going to get a mean reversion in rates, and that's what we're seeing. Nice breakdown yesterday. Gotta love that. And, I think rates probably see 2.2 on a 10-year.
Okay. All right. So how do you play that through the TLT ETF? I remember talking about that 132 level with you before. Or do you actually like to trade the bonds at the SIBO, pretty liquid instrument?
I mean, you could do it a number of ways. You could short TLT. You could buy TBT. You can short the futures themselves. You could buy put options on the TLT. I mean, it really all depends on what your time horizon is, what your risk tolerance is. All of that is very important, and I can't answer that question for you.
Okay.
Overall, if I think rates are going up to 2.2, bonds are going to get hit. The way to express that theme or that thesis, it really depends on who you are.
And even if rates go nowhere, you still think that they're going to hit the bonds, just in anticipation of something happening.
I mean, listen, let's put things into perspective. I mean, rates are at 197 on the 10-year, and I think they go to 2.2. So, we're talking about a blip in the whole, to put things into perspective, I mean, this is literally less than nothing. So when we talk about a tactical trade, I mean, this is something that, we're doing now. Bigger picture, Fed Fund futures, which I continue to point to, are now signaling, if I'm not mistaken, last I checked yesterday was 37% probability of a rate hike at the late October meeting. I mean, they're not doing anything this year. And just to hear these conversations about, hearing these economists arguing about whether or not they're going to raise rates in June, I mean, that just makes me sick to my stomach. They're not doing anything.
Okay, let's move on to
bigger picture rates. So bigger picture, I think rates stay low. But tactically, for a quick little mean reversion to 2.2, I think we're seeing it.
Boy, talk about a tough stock to trade here. Netflix. Yeah, I mean, you had the gap and go off earnings. I mean, you are forming some kind of resistance here. I mean, I was talking with Brent about it yesterday, and it did have a breakdown through, some support of 458 or 558. But, I mean, it's just so hard to get excited about this thing on the short side, number one, because so many people are short and stuck. and you had the people that were taking a shot on the short side over the last 3, 4, 5 days, just looking at a huge move as far as standard deviations go. And so if they're shorting it in the 570s and they have a chance to bring it in into the lower 560s or higher, lower 570s or higher 560s, they're going to bring it in. Give us your analysis of Netflix.
I mean, I think Netflix is a beast. I mean, I think if you're trying to short this, I think you're trying to get real cute. You're picking up pennies in front of a steamroller is what you're doing. So shorting this, I mean, anybody short this deserves to lose money, I think. The more times that the level is tested, the higher the likelihood that it breaks. And we kept bumping up to this 460 level, 460, 480 level. Going back to early last year, we tested that level 4 times. So I'm not surprised that we broke out. Very similar concept to why, I think we break out in S&Ps. We keep bumping up against this level. Same thing on the Netflix. We got a gap on the earnings. I think we're consolidating here, and I think we keep going. I think we see 600 soon. I think any weakness needs to be bought. So this is a name, right? So this is a good example of a name where instead of trying to fade highs, I'd rather be buying weakness.
A couple stocks that had incredible pops yesterday morning there and didn't get a lot of media attention here were Visa and MasterCard. I'm not sure if either of these stocks showed up on your radar there yesterday, but Visa actually popped over $4 at one point yesterday morning, and MasterCard was up over $2 yesterday too. Do you follow these two stocks, and what are your thoughts here?
Yes, of course, particularly Visa, because I find the Dow components, the analysis that I do on all 30 Dow components, I do it on a weekly basis. I think that's one of the most valuable exercises, that we could do as market participants because, there's no way to quantify the breadth, when you're going over all 30 Dow components. It's very difficult to quantify, but, if the majority of the Dow components look like they're in uptrends and look like they're heading higher, very difficult for the market as a group to have a steep decline or correction. So taking those components as an aggregate, I find extremely valuable. So to answer your question, yes, I look at Visa and I think that I think it's an important stock. Visa hit our target, over the last quarter and a half or so. So we've kind of been shying away from it. Overall, it's still an uptrend. It still looks great. I think we could put this in the category of a name that I'd rather be buying weakness than selling it to strength. I like it. It probably heads higher.
Okay, I've been a big fan. I know you've been a big fan of social media here. First, we'll take a look at the ETF, get your thoughts on that. Still kind of chart looks like the exact same thing it did last time. But let's talk about the ETF and then go and discuss Facebook a little bit.
Yeah, I mean, listen, this thing's been a home run, as you guys know. I was pounding the table, loved it at 18 and a half, 18 and a quarter-ish. Here we are pushing 21 in a very, very short period of time. We're running into the highs from last September. So is this where we want to be, pounding the table to get long here? I mean, if it took you this long to own it, now's probably not the time you want to be buying it. I'd rather be, tactically fading something like this right now. But structurally, bigger picture, I mean, it looks great. What's there not to like? Again, this is a buy the weakness sort of name, not necessarily fade strength. But, if you're not in it already, now's not the time. In terms of Facebook, I guess it's kind of like a similar situation. Been a big winner. I've liked it for a while. I'd rather be buying weakness than fading strength. Like I said, it's hard to put new money to work here. I didn't catch what it was doing pre-market. I know that they had their little their
conference call?
Earnings release or whatever yesterday. I guess it's not really doing much, which is I would consider to be positive. The fact that it can get through an earnings release without a lot of volatility, bigger picture, I think that's good. Again, a name that we want to be buying weakness, not necessarily fading strength. There's a leader. That whole space, leaders, 100%.
Tonight we're going to get Google, Amazon, Starbucks, Microsoft, Pandora, Juniper. What are your thoughts here on a couple of those big dogs like Google, Amazon, Microsoft, JC?
Google's an absolute beast, guys. I mean, look at the Dow Jones Internet Index. I mean, you want to talk about leadership. I mean, this has been a monster, and Google obviously a huge component of the Dow Jones Internet Index. For you guys at home, you can look up FTN, Frank, David, Nancy. That is the Dow Jones Internet Exchange Traded Fund, sitting here making all-time highs, which is nice to see, obviously. And I think I'd have it a lot higher And those are the names, the Amazons, the Googles, the Netflix of the world. All of those are components. And I mean, when you talk about Google, I mean, this is one of the strongest names on earth. You know, short term, very tactically, I don't like where it is. You know, this is something I'd be buying right now. But look bigger picture at the highs from last February. You know, we're in a nice, you know, downtrend channel. You know, very beautiful. You know, call it a bull flag, call it whatever you want. But what it's really doing is consolidating the monster gains from the you know, that we've seen over the last 6 years in what I consider to be a very healthy fashion. So, you know, we want to be buying breakouts above last month's highs. So, you know, look at the March highs. You know, that's the upper end of that channel. We start taking those out. I think we're off to the races. I think the stock goes a lot higher.
Do you think Google? I've argued for a while. I think Google could eventually overtake Apple to be the most valuable company in the world. Do you think that's possible?
Maybe. I mean, what do I know about that? You know.
Yeah, you're a technical guy. You're a technical guy, rookie.
I can tell you what I think, but I mean, nobody at home cares what I think about valuation. You know.
Gotcha.
Okay. Dennis mentioned Pandora. It's due to announce earnings here. Another company that trades a lot. I don't know if they really make any money here, but finding some nice resistance here. Is this one you're looking here for a breakout over the $18 level?
Yeah, probably not. I mean, it does, you know, they don't get much worse than this. I mean, Pandora, what a disaster. You know, this is you fade strength in the same. I mean, there's really nothing to like here. This is you got priced, you know, below a downward sloping 200-day. You know, can you maybe get a little bit further mean reversion, maybe another point or two, possibly? But is it worth the risk? I don't think so. Not to me.
Okay, just talk about mean reversions. Just want to get your final take here on crude oil here. We've had a nice rally off the lows. Everyone leaving it for dead at 45. Now we're coming back up towards the $60 level. Taking a little pause here. Mean reversion, where would that take us to here in crude oil?
Yeah, I mean, you know, you guys know, you know, I originally started liking this at 47. I thought that's where you needed to buy it. You know, structurally, I thought that was a great entry. You know, technically, I thought that was a great entry point. Structurally, I think this action is very constructive. You know, but we ran into the February highs, and I told you guys last week. You know, I got long. You know, on the original breakout. You know, back in March. But you know, we faded this last week. We faded that strength, and you know, the idea is you fade those highs, you take the profits, right? You put a smile on your face, and then you want to see how it reacts to those highs, how it, you know, absorbs and digests that overhead supply. You know, I think it's a little too early to say it's doing it in a good way. You know, that's not true. I guess I could say, yes, I'm happy with the way it's digesting these gains. You know, I want to see a little bit more consolidation. If we can get a little bit more of a little bull flag here, we want to buy the breakouts to new highs. I think we probably get it. You know, probably 59, 58 and a half or so. I think you buy that breakout. You know, as a re-entry. I mean, that's what I would do. You know, we'll see. You know, we faded the strength, so we're not in it. But I got to tell you, I do like the way it's consolidating. I'd like to see some more of this stuff.
J.C. Parets, founder of Eagle Bay Capital, money manager, chartered market technician, joins us every Thursday on Benzinga's Pre-Market Prep, brought to you by Marketfy. Thanks a lot, J.C. You kind of took it easy on us today.
Thanks for having me, guys.
All right, we'll talk to you next week.
All right.